The iron butterfly. What's going on, guys? So in this video, we're diving into the iron butterfly options trading strategy, and we're going to be covering how to do this, what it means, and what you need to take away from this strategy here in this video on the Webull platform. We'll leave a link in the pinned comment and description box if you want to sign up with the Webull, so you can do this on the same platform, but you can of course do this on any platform of your choosing that allows you to trade options. You just might need to be approved for a certain level of options trading to be able to utilize and do this strategy. So here we go. We are on Investopedia like we always like to go and start with, and by the way, I'm sorry, my sunglasses are still on. Take those off, put them to the side. So iron butterfly. So this is another strategy that on the surface, we are looking for a stock to kind of stabilize. We don't want a stock to go crazy. We're looking for it to kind of stay still, low volatility, and we want to take advantage of the options. So the strategy combines a bear call spread with a bull put spread with an identical expiration date that converges at the middle strike price. And this essentially, the short call and the put are both sold at the middle strike price, which then kind of forms the body. So we'll explain this, we'll show you guys, and we'll have a visual so you can see this in just 1 second. But we're gonna get paid a net premium, okay, utilizing this strategy, where as opposed to the traditional butterfly, which we actually have a video on, if you guys haven't seen like a couple days ago, go check out that video that we just talked about, the butterfly spread. After this video, if you'd like to, it's probably a better place to start, but they're somewhat similar. So we're getting paid a net credit instead of paying a premium for the option, which you'll have to do with like a debit spread type of butterfly strategy. Now, this also is going to require 4 contracts instead of 3. So we only needed 3 contracts to trade on the butterfly. Now, technically it was 4 contracts that we were dealing with in the examples, but we only needed 3 strike prices and 3 different options contracts. We just bought 2 or sold 2 of one of those. In this case, we're dealing with 4 different options contracts. So the biggest takeaway here, guys, is this line right here is best employed during periods of low price volatility. So if things are still, maybe it's the summer, there's not too much money in the market, people are on vacation, hedge funds are gone, right? That type of deal. And there's not too much craziness going on in the world, the economy. It's kind of like we're doing its thing, chopping up and down little by little here and there. This could be a really good strategy, right? So rather than us reading this off, let's go through some examples ourselves, but let's just visualize it first. This is always a great place to be when it comes to visualizing. So our max profit is at that center strike price, okay? There's gonna be a lower strike price, an upper strike price, and in between those is the center strike price, and our max profit will be right in that center, okay? This line indicates break even, and then we have kind of where we'd sit at max loss wise if we end up above our upper strike or below our lower strike. So let's dive into that. Let's talk about some examples and let's show you guys how this works. We are on Webull. Again, links will be down below if you want to get access to the platform. Here's Apple. We're going to use Apple as an example because it's a great stock to use as an example. We are kind of trading in this range right here, broader scale. If we zoom things out a little bit, you guys can kind of see what I'm talking about. Yeah, I mean, it's a nice little kind of, range to the upside, nice movement to the upside, so you can't complain about that if you are an Apple long. Let's go to the option chain. Right now we are looking at single options in the top left. What you'll need to do, Webull is going to do this all for you. You go here, scroll on down to where it says iron butterfly, and they're going to take care of all the work for you. This should be a shorter video than the last one because we don't have to deal with calls or puts. It can only be done like 2 different ways, and we'll explain what we mean by that in just 1 second. So I command or control clicked on the buy. Now what I'm gonna do is I'm gonna dive into this in just 1 second, but I want to change around the widths so that we can see things a little bit better. Let's go to a width of 5 so we can kind of see this a little bit better and it's a little bit easier visually on us. So I'm gonna zoom in a touch more, and now what I'm gonna do is, you may not see this page first. We're in the order entry. You may see this table. So if you see this table, then that's fine, but I would recommend the graph to visualize it and then go back to the table, maybe to check your numbers, make sure everything is aligned, and then you can kind of enter it in. But you can also enter it in on the graph, and underneath me, there's a place order button right here. Maybe I'll move myself out of the way so you guys can see that for 1 second. And with this, we now have the visualized kind of approach to this iron butterfly strategy here, okay? So what I'm going to do is I am going to change the number of contracts. I'm going to change it in the table up here to just 1. So we're not dealing with 10, just so we can deal with simpler numbers to make it easier on us. Now, of course, multiply this out by however many contracts you want to trade, your risk tolerance, your risk management, all that type of stuff. But right now in this example, you can change the contracts here as well. So we are dealing with Apple and we are dealing with the $150 strike price. That's the middle ground. We're dealing with the 145s and the 155s. That is a width of 5. That width is a 5 because it's $5 or 5, I guess, whole dollars from this area, this lower level strike, the 145s to the middle ground, and then 5 from the middle ground to the higher strike right here. Our max profit in this situation, if we are utilizing this type of iron butterfly strategy, our max profit is going to be if Apple finishes above or below our high or low end strike prices. So the way this changes is if I go up here to the top right and I click on sell. So there's two different ways you can go about it, and we'll explain in detail both. Let's start here by going with the buy side. Okay, so if we're going to go ahead and buy a iron butterfly option, I guess if you want to call it that way, then we're going to have to pay out of pocket. Okay, we talked about at the beginning, the net credit on our account. That's if we go ahead with the sell side. Okay, that's going to give us a credit. It's at the bottom of the screen right here. It'll tell us a credit right now would be given to us if I went ahead and I executed this right now. I would get a credit of $338. Okay, on the buy side, I'm going to have to pay $338. That's called the debit. Okay, so on the buy side here, what are we doing? Let's go over to the table and let's explain this. So let's go leg 1 through 4. The first leg is that lower level strike. With the lower level strike, we have 145 set, okay? Our higher level is going to be 155 and our middle ground is 150. What we're going to do is we're going to sell, indicated by the red, leg 1. We're going to sell a put, okay? That's our first step, is sell a put on the lower level strike. Then leg 2, we're going to then buy a put at the 150 at the middle ground, the middle strike. We're going to then buy a call at that 150 at the middle ground. That's leg 3. Then we're going to go ahead and sell a call at 155. That's the higher strike. That's leg 4. Okay, so that's what you're doing on the surface of how this works. Okay, go back to the graph. On the buy side, on using this exact kind of step-by-step, each of these legs in that order, okay, we want our stock to expire or to finish by the expiration date in the extremes, either below our lower strike or above our higher strike. That's going to get us our max profit, and we're going to make money, and we're going to be happy. If we expire in between, we're going to lose money. Okay, actually, there's a break-even point, which are indicated by these little arrows right here. So our break-even points in this case is if Apple is above $146.62 and below $153.38. That would be where we lose money. And worst case scenario is Apple finishes right in between at 150 and we lose the max loss of $338, which is what we paid for this option. Now let's go to the sell side. I'm going to go to the top right, click on sell, and now we kind of come back to where we originally were looking at that picture. Go back here, it looks very similar to this, okay? We're back to that picture. Now we make money if Apple is in between. If Apple doesn't move too much, there's not that much volatility, we make money now, okay? So how do we do this? Well, it's a little bit different on how we go about this, but in this case, we're going to have to buy the put and the call on the low end and the top end, and then sell the put and the call in the middle. So it's kind of the exact opposite of what we just did. So again, go back to our table. For this iron butterfly strategy, what we're going to now do is we're going to buy a put at $145. Leg 2, we are going to sell a put at $150. We're going to sell a call at $150, and then we're going to buy a call at $155. Fairly straightforward, okay? Now, if I was to go back, guys, you can change it right here. See where it said on the side, where it says SI at the top? On the top line, where it says iron butterfly, we can change our strike, expiration date, whatever I want to do. If I go to this and click on buy, it's going to flip, okay? So now we're back to leg 1 being selling a put, leg 2 buying a put, leg 3 buying a call, and leg 4 selling a call. Back to the graph, I want to kind of also hammer this home. We're going with a limit order. I can change that to a market order. That could throw off my price points because we are dealing with 4 option contracts, okay? We need to understand that when we are putting this order in, we are dealing with 4 contracts. So what Webull is going to do is it's going to try to get you at the best price across all of these different contracts. That could be a pain, and that's why these limit prices could be a little bit off. I would personally recommend starting with a limit order, take this notch down, bring it down a little bit, or bring it up depending upon which way you're looking to get in, right? if you're looking for the credit side, so if you're looking on the sell side, which is this example right here, then maybe you want to bring this up to see if you can get a higher credit, which is going to be what you're going to get paid. And that's ideally what you want to do. If you're on the buy side, you don't want to pay as much. Maybe you bring your limit price down to bring up your potential profit, bring down your potential loss. Maybe that's how you kind of go about that. And then when you click on place order right here, it may take a couple minutes to process this or to get it filled. Now, if it doesn't fill right away, you can always go back and edit your order. In your orders tab of Webull, you can edit your order and bring that limit price up or down accordingly to get filled on your option. That's what I would recommend, because that could be the difference of a couple dollars either way, which doesn't sound like a lot, or a couple cents either way, but that could be a pretty big deal when it comes down to, your bottom line or compounding this strategy over time, years, months. It could make a lot of sense and it could be important. So that's that. Hopefully this video was helpful. Leave any questions, comments down below. Check out our other videos going over different options trading strategies. We just covered the butterfly in the last video. Links and resources down below. Some free stocks with Webull. Moomoo's giving away a bunch of free stocks when you sign up. Also Public, a technical analysis course. Links to our other channels. Tons of resources down there. Check those out. Hit the thumbs up button. Consider subscribing. We'll see you guys in the next one.